welcome to this month's Financial Markets Update. Well, the month of December was a really strong month for financial markets. We saw really quite exceptional investment performance across all the major asset classes. Over the course of the month, the listed REIT market was particularly strong with both A-REITs and G-REITs over 8.5% higher throughout the course of the month, but also the more cyclical growth areas of the market, so global small to mid caps were also quite materially higher relative to other global equity markets over the course of December. Bonds, on the back of lower bond yields over the course of the month, were also higher, so we actually had a period not too dissimilar to the month of November where markets by and large were all higher, and this resulted actually in a really solid end to the calendar year in terms of overall investment market performance. And this is against a backdrop of higher cash rates coming through the system throughout the course of 2023, as well as obviously ongoing geopolitical and trade tensions that continue to put pressure on financial markets and the global economy as a whole. When looking at the performance of the month of December, you can see here from this chart that the decline in global bond yields across all the major markets contributed significantly to the overall performance of both equity as well as fixed income assets throughout the course of December. And as I said, this move down in bond yields is really on the back of market expectations that central banks have now reached the peak in terms of cash rates, and the next move obviously will be down at some stage throughout the course of 2024. From our perspective, we think there definitely will be cuts in official cash rates throughout the course of 2024, but most of those will be coming through the second half of the calendar year as opposed to either in March or through the June quarter. We think, as I said, central banks will really look to sit on their hands to really ascertain the inflationary outlook and really look to see that it is certainly mired in central bank target levels, which is in that 2 to 3% band around most developed market economies. But notwithstanding that, as I said, the market certainly, as I said, took the view that lower cash rates were coming through and we resulted in, as I said, a significant decline in bond yields, and that sort of the performance of fixed income and other markets move higher. As we sit here today, we probably think fixed income markets are trading probably around about fair value at the moment, just sort of given both the economic as well as inflationary backdrop. So from our perspective, we think that the rally that we've seen in fixed income markets through the second half of this year, we think probably will start to flatline a little bit through the early part of 2024. But notwithstanding that, where bond yields are at the moment, which is sort of back above 4% in the context of domestic 10-year bond as well as what we're seeing in the US, we do expect that they will still continue to ratchet lower over the course of the year as cash rates start to come through, as I said, most likely through the middle part of calendar year 2024. When looking at the overall performance over the December quarter, the months of November and December were very strong for financial markets, and this really did contribute to, again, a really solid investment quarter for financial markets. And again, right across the board, we saw that both in terms of equities, property and related sectors, as well as fixed income sectors. So this really contributed to a solid investment performance when looking at it from an overall portfolio context. The advantages of having both a flexible asset allocation approach and a well-diversified investment strategy throughout the course of the fourth quarter really would have paid off in terms of overall investment market performance at a portfolio level. And when thinking about calendar year 2023, interestingly enough, when we sort of look at the overall performance in terms of the individual asset classes, and despite the challenges that we've seen both in terms of geopolitics as well as obviously the ongoing regional tensions that have become more prevalent throughout the course of the year, investment market performance was actually very sound. And again, this was against a backdrop both of higher cash rates, rising bond yields, certainly through the first half of the calendar year. So financial market performance over the course of calendar year 2023, when you're looking at the long-term averages, wasn't too dissimilar in that sense. And certainly some of those sectors that had a pretty difficult 2022, such as REITs as an example, were able to deliver some solid investment performance over the course of calendar year 2023. When we think about outlook for 2024, from our perspective, there's probably sort of four key themes that we're focusing on at this stage of the investment cycle. The first of those is very much built around the outlook for cash rates and interest rate sensitive sectors in the near term. As I alluded to just previously, we certainly take the view that cash rates are going to be lower throughout the course of 2024, but we think that really that's going to be driven through the second half of the year as the shift down in inflation, even though it's been quite pronounced over the last 12 months or so, we think it's going to take a little bit longer for it to really move back towards sort of central bank target levels on a consistent and sustained basis. So from our perspective, we think cash rates will move lower, but ultimately that's going to be driven by inflationary expectations coming through and moving lower over the course of 2024. But by and large, that's going to be positive from our perspective. When we look, as I said, cash rates where they are today, we think they'll be lower. We think that's going to benefit both fixed income as well as other growth assets throughout the course of the calendar year. The second one is very much around the China story. Certainly the economic activity in China was materially weaker than global activity, particularly in the US when looking at it on an adjusted basis. And we do expect that growth in China, even though we've seen some policy changes, particularly both out of the government as well as the PBOC, we think more is going to need to be done in the context of supporting the Chinese economy. And as we sit here today in regards to the challenges, particularly in the property sector, Evergrande, Country Garden, are all suffering significant capital losses and potentially looking at liquidation in regards to their business model. So from our perspective, said the property sector, which has certainly been a mainstay of the Chinese economy over the course of the last decade or so, we think that there's going to definitely need to be further policy stimulus coming through from both the government as well as through the PBOC, and also probably a change of direction in regards to the treatment of foreign capital and the ability for foreign capital to have the comfort level in order to move back into the economy. So I think that the outlook for China is going to be really critical in the context of financial market performance more broadly, particularly as it relates to emerging markets, given the weight of the Chinese equity market in overall indice performance. And then we've clearly got geopolitical and ongoing trade risks associated with global markets, and we're certainly seeing that, as I said, continue. We think that US-China relations again is going to be an important driver of financial market performance, as well as obviously what we're seeing in regards to the regional conflicts both in Europe and the Middle East. And we think that clearly that's going to impact investor sentiment, also have an impact on commodity prices such as energy and the like. So the end game around both of those two issues from our perspective, we think again will be significant in the context of overall investment market performance. And the fourth factor, it's only early days, but we think it's going to continue to loom large over the course of 2024 is the US presidential election. And we've had obviously some early primary delegate voting as it relates to both Republican as well as the Democratic Party. Most likely, obviously, Joe Biden being the incumbent will get the nomination for the Democrats. And as we sit here today, certainly Donald Trump looks the favoured for the Republican candidate. So another 2016 match-off between Biden and Trump. But again, it's going to be an interesting dynamic. Markets will probably be a little bit more better prepared for a Trump presidency if it does come about and eventuate through the back end of 2024. But certainly, as I said, there's going to be, as I said, a lot of that riding in terms of a market performance, as well as obviously in terms of the confidence side of it, as well as we move throughout the course of 2024. So overall, December was a really strong month for financial markets and capped off what actually was a very solid year in terms of overall investment market performance. From our perspective, as I said, sort of four key themes that we're focusing on into the early part of next year. But the key thesis from our perspective certainly will be to maintain, as I said, a flexible and well-balanced investment strategy across all of our portfolios. As I said, to be able to ride out those challenges, but equally take advantage of the opportunities as they will present themselves throughout the course of 2024. As always, if you have any queries about our portfolios, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks and bye for now.